Hi everyone, welcome to today's episode of iFAST TV. My name is Bolun, a research analyst from Singapore, and today I'll be sharing on the recent FTX collapse in the crypto space, why investors should continue to avoid crypto, and some suggestions on where investors can invest instead. 2022 has been a terrible year for the crypto market, filled with leverage, greed, fraud, and the lack of transparency, and is unlikely to get better anytime soon. From the implosion of the largest algorithmic stablecoin, Terra Luna in May, to the collapse of the multi-billion-dollar hedge fund, Three Arrows Capital in June, there seems to be no end to the list of bad news, even as more than $2 trillion has been wiped off the crypto market since peaking in November 2021. Cryptocurrencies have always been seen as a form of higher risk, higher beta investment by the wider markets, and thus, it does not come as a surprise that crypto has not performed well this year in the current risk-off environment, as financial conditions across the world start to tighten. Bitcoin, being the bellwether, has fallen by more than 65% year to date, while Ethereum has created close to 70%, despite the recent hyped-up merge. While the majority of the alternative currencies are also down by more than 90% from the peak back in November 2021. Meanwhile, traditional asset classes such as bonds and equities have far outperformed cryptocurrencies, despite also falling across the broader markets. With the blow of the world's second largest crypto exchange, this crypto winter is likely to be a long and dark one. The unraveling of billionaire Zheng Bankman-Fried's $32 billion crypto empire was swift. In less than 72 hours, FTT, the native cryptocurrency token of the platform FTX, fell by more than 80%, from $22 down to a mere $4, wiping up over $2 billion in value for FTT token and about $200 billion from the entire cryptocurrency market. It all started when CoinDesk published a revealing balance sheet of Zheng Bankman-Fried's Alameda Research trading firm, showing most of the assets were held in FTX exchange-native FTT token. A few days later, CEO of Binance, Changpeng Zhao, also known as CZ, took to the Twitter and stated that he was liquidating his remaining tokens, followed by a series of tweets with Sam, citing animosity. As rumors spread that FTX was facing severe financial constraints, customers rushed for the exit, resulting in a bank run scenario, which ultimately forced FTX to reach out to Binance for help. When Binance decided to back out of the deal, citing that FTX's financial condition was beyond its control or ability to help, FTX was forced to file for Chapter 11 bankruptcy 2 days later when it could not raise enough cash. Following the bankruptcy filing, it was revealed that right before the collapse, FTX only had roughly $900 million in liquid assets, a far cry from the $9 billion in liabilities. As regulators and investigators dug deeper, it was reported that there were at least $1 billion of customer funds missing from the exchange, which raised the alarm of the case of a potential misuse of customer funds. To make matters worse, hackers managed to steal approximately $477 million worth of tokens from FTX in the weekend following the bankruptcy announcement, which further deepens concerns about the lack of safeguards within the company. As it stands, investors and customers of FTX are unlikely to ever recover their money. Whatever the case is, there is no doubt that there are a lot of unknowns, and with such serious allegations of potential fraud being mentioned, the downward spiral of crypto assets may perpetuate as confidence among crypto investors continues to wane. Not to sound like a broken record, but we have warned investors time and time again to avoid speculating in cryptocurrencies. Since 2021, we have continuously cautioned that cryptocurrency is a zero-sum game, more akin to gambling rather than investing. And despite all the promises this profound technology can bring to society, none of it has been delivered, but instead filled with numerous scandals and cases of scams. As we have previously mentioned, a major shortcoming of crypto is the absence of fundamentals and an intrinsic value, which continues to hold through today. The inability to generate any form of cash flow simply makes it impossible to derive an intrinsic value, which gives rise to negative implications such as asset bubbles. While the crypto asset bubble has already popped since its peak in November 2021, no one can gauge how low crypto prices can fall, since there is no reliable way to gauge its intrinsic value, which makes it not suitable for a long-term investment portfolio, and absolutely not advisable to catch the falling knife. As it stands, there is still no real-world use case for cryptocurrencies other than the transactions of NFTs, which fluctuate in value based on hype and attention rather than their intrinsic value, and the gimmicky applications in the decentralized finance market. The lack of a stabilizing force, coupled with volatility, also makes cryptocurrency a poor form of currency, especially when its existence is in direct competition with central banks, which are also rolling out their own version of central bank digital currency. Lastly, true decentralization is simply an idealistic utopia, as the very reason regulations are set in place is so that the interests of investors and clients are safeguarded. It is also hypocritical to float the word decentralization as a bulwark against controlling central entities, since the majority of cryptocurrencies are held by a few whales, much like how the institutions control most of the assets in the real world. However, the key difference is that there are proper frameworks and regulations set in place to protect the interests of clients in the real world, which are largely not present in the crypto world. With the collapse of FTX and revelations of shady deals behind the scenes, trust in the crypto space has never been more difficult to regain than before. Furthermore, since FTX is reported to have 134 affiliated companies and more than 1 million creditors involved, we believe that the contagion in the crypto markets will continue to spread, and the worst is yet to come, given the intertwined and leveraged nature of the crypto market. Looking ahead, regulators will have to step up their game and clamp down more ferociously on the crypto space, in an effort to prevent continued widespread fraud and unregulated casino-like behaviors. Needless to say, confidence in the crypto market has been shaken substantially following these events, and it may never recover. This is going to be a long and dark winter for crypto, and no one truly knows what the future holds. However, until there is a better use case, greater transparency, and a proper regulatory framework, we would like to emphasize once again that investors should stay clear of this greater fool investment asset class. Despite the catastrophic failure and collapse of FTX, not all hope is lost. In fact, if you have lost money in the recent crypto fiasco, you are not alone. Even institutional investors have lost a significant sum of money, with Sequoia and Temasek each writing down their investments worth over 200 million in FTX to zero, including dozens of other professional investors. While it is totally understandable to feel upset over losing your hard-earned money, we should always be optimistic and look at the bright side of things. As humans, all of us make mistakes from time to time. The important thing is that we learn from our blunders to prevent similar occurrences in the future, as you will truly be ashamed if we walk away without learning anything. Moving on from here, we urge investors to stay away from cryptocurrencies and instead opt for investments with proper fundamentals, as the price of an asset is ultimately determined by its earnings. As we head into an increasingly likely recession, we can recommend investors to take a more defensive approach, focusing on fixed income and value-oriented equities. For investors with a lower risk profile, they can consider allocating a greater proportion of their portfolio to fixed income, namely investment-grade bonds, bonds with shorter duration, and Singapore-centric bonds, which will likely be more resilient in a rising rate and recessionary environment. As for investors who would like to adopt a wait-and-see approach and prefer to hold more cash on hand, they can craft a cash management portfolio to better utilize their idle cash. Investors may customize their portfolios to suit their investment risk profile. As for investors with a higher risk profile, we recommend allocations to US value equities, which are likely to outperform their growth counterparts in the current macro environment. Alternatively, investors who prefer Asian equities can consider the Japanese market, which has more attractive valuations compared to the US market. As for investors who would like more exposure in the emerging market, they can consider an allocation in the ASEAN region, which we believe will be more resilient in an economic downturn. Overall, it will be prudent to have a good balance of both bonds and equities according to your risk profile, investment objectives, and time horizon. And that will be all for today's sharing. Thank you for your time, and do look out for our upcoming videos where we will share in greater detail our 2023 outlook and recommended investment themes.